Imagine trusting a portfolio split neatly down the middle, 60% stocks for growth, 40% bonds for stability, and believing you've found the holy grail of safe investing. For decades, this mix was the gold standard in retirement circles, celebrated for its supposed balance. When stocks stumbled, bonds rallied, and your overall value stayed relatively calm. Advisors touted it as the perfect hedge, a soothing alternative to all-in equities or the meager yields of cash. But here's the shocking part. That negative correlation between stocks and bonds, once rock solid, has started to crack, and when it breaks, the entire facade of safety collapses. Think back to the last few market shocks. In early 2022, as inflation spiked, both equities and bonds slid in tandem. Bond prices, hammered by rapidly rising interest rates, didn't cushion the stock market swoon, they accelerated the sell-off. Retirees who leaned on the 60-40 rule watched their portfolios lose 20% or more in a matter of months, with no ballast to soften the blow. The illusion of safety evaporated faster than they could say rebalancing. Worse yet, in a genuine crisis, with liquidity drying up and forced redemptions mounting, both legs of the traditional portfolio can succumb simultaneously, leaving retirees exposed with nowhere to hide. What's most insidious is that the 60-40 mantra still carries the weight of industry consensus. It's taught in business schools, written into retirement software, and repeated on financial news until it feels like gospel. Yet in today's interconnected markets, where central banks' policies ripple straight through bonds into equity valuations, that old rulebook starts to feel outdated. Dangerously so. If you're relying on this time-worn strategy without questioning the new market dynamics, you could find yourself in free fall when the next synchronized downturn arrives. Don't let the comfort of convention blind you. Understanding that the 60-40 safe mix is more fragile than ever is your first line of defense against a retirement plan built on cracked foundations. When interest rates shoot up, like they did in 2022 and 2023, bond prices don't just wobble, they crash, and that crash isn't limited to junk debt or shaky corporates. Even government treasuries, once hailed as the ultimate flight to safety, can lose significant value overnight when yields surge. For retirees holding a 40% bond allocation, this dynamic has become a hidden landmine. In a traditional 60-40 portfolio, bonds were meant to buffer equity swings, but in a rising rate environment, they become a second anchor, dragging your retirement nest egg deeper into the red. Consider this. When the Fed raises its policy rate by a full percentage point, long-term bond yields often climb even more, meaning those long-duration bonds held in many target date or balance funds can lose upwards of 10% in market value almost immediately. And these losses compound if rates keep climbing. Worse yet, corporate bonds and municipals, once praised for their higher yields, face widening credit spreads in volatile markets, so they, too, bleed value as investors demand greater compensation for risk. Suddenly, the conservative slice of your portfolio is printing losses that rival your equities, erasing the cushion you thought you had. Retirees who relied on bond coupons for income suddenly found themselves selling bonds at depressed prices just to meet living expenses, realizing far less than they'd anticipated. And with yields already elevated, many assumed bonds were a safe long-term play, but a bond's yield to maturity only materializes if you buy today and hold to maturity, which ignores the painful mark-to-market volatility in the meantime. In a crisis where both stocks and bonds sell off simultaneously, that 40% bailiwick offers no refuge, only deeper wounds. If you haven't recalibrated your view of bonds in the face of rising rates and shifting credit dynamics, your safe retirement plan may collapse under the next bond market tsunami. Early withdrawals during a market downturn are painful enough when only stocks are declining. But when your bond safety net unravels at the same time, sequence of returns risk morphs into a financial avalanche. Imagine you retire with a $1 million portfolio split 60/40ths. You plan to withdraw 4%, $40,000 each year, adjusting for inflation. In a normal year, that's fine. But suppose in your first year you see a 20% drop in stocks and a 10% drop in bonds. your ending balance plunges to roughly $660,000, and that's before you make your withdrawal. When you then pull out your $40,000, you're effectively taking a larger percentage of your smaller base, nearly 6%. In year 2, you need a 42% rebound just to break even on your portfolio's original value. Meanwhile, you still have living expenses to cover. By the time markets inevitably recover, you've already chipped away at your principal far deeper than you would have with a purely equity drop. This isn't abstract math. It's a real risk for retirees who depend on systematic withdrawals to fund daily life. What makes it worse is the compounding impact of continued withdrawals. Each subsequent 4% distribution represents an even larger slice of a depleted portfolio, accelerating the downward spiral. And while bonds once offered a calming counterbalance, the synchronized sell-off in fixed income turns that ballast into an extra weight. In true crises, like stagflationary environments or sudden rate shocks, both asset classes can tank together, delivering a 1-2 punch that traditional portfolio theory never fully anticipated. Sequence of returns risk is magnified by timing. The earlier a severe downturn occurs in retirement, the more devastating it becomes. Withdrawals during downturns lock in losses. Recovering those losses requires outsized gains. Gains that may never materialize, especially if the economic shock reverberates for years. For retirees, this means even a single bad sequence of returns can permanently impair spending power, forcing deeper cuts, lifestyle reductions, or riskier portfolio moves just to catch up. If your safe 60-40 bucket collapses under the weight of simultaneous market and bond crashes, you lose more than money, you lose control. Recognizing how sequence of returns risk is amplified in a dual asset downturn is essential to building a retirement plan that doesn't crumble at the first sign of synchronized stress. Today's bond yields sit near historic lows, which means the 40% safe portion of your 60-40 portfolio produces barely enough income to cover a modest withdrawal rate, if that. Imagine depending on a 2% coupon from your bond holdings to supplement your portfolio's growth and keep your 4% annual withdrawal intact. In a rising rate environment, you watch older bonds lose value while new issues pay richer yields, but you can't easily swap them out without crystallizing losses. So you sell at a loss just to capture a low coupon, effectively locking in negative real returns. This low-yield trap forces retirees into an ugly choice. Sell more assets than planned to generate the same level of income, or accept lower income and risk falling short on basic living expenses. Married to the idea of a 4% safe withdrawal rate, many keep the 60-40 split, but find that the bond leg only contributes 1% to 1.5% in interest, meaning the equity portion has to carry nearly all the income burden. When the market dips, equities offer no refuge, and bonds simply can't pick up the slack. Worst of all, selling bonds at depressed prices to meet spending needs turns a temporary market blip into a permanent principal reduction. You lose more capital now and have fewer assets to benefit from eventual market recoveries. Over time, this dynamic accelerates the depletion of your portfolio faster than a 60-40 model should allow, erasing the very safety cushion you counted on. As yield cycle, retirees accustomed to reinvesting bond maturities into fresh high-yield issues face the reality. Future returns may be far less than hoped. And because bond allocations are meant to be stable ballast, advisors seldom address the need to tweak that mix in low-yield regimes. You end up funneling money out of your nest egg at a pace that your bond income can't sustain, forcing deeper equity sales or cash drawdowns, both of which heighten sequence of returns risk. Recognizing that low yields can create an income shortfall is critical. In market downturns, a portfolio designed for moderate income can quickly become one that fails to meet your needs, undermining the very premise of safe retirement planning. Inflation can feel like an invisible tax on your retirement plan, slowly eroding both the bond coupons and any equity gains you might enjoy. In a balanced 60-40 portfolio, you expect the bond leg to deliver reliable income, even if modest, and the equity side to provide growth that outpaces inflation. But when inflation spikes, it can undercut both simultaneously. Take a scenario where inflation jumps to 5%. Your bond holdings yielding 2% suddenly deliver a negative 3% real return, meaning every dollar you earn buys less. At the same time, equities, particularly dividend-paying blue chips, may struggle to keep up as rising input costs squeeze corporate profits and force investors to demand higher yields, which can depress share prices. This double whammy strikes hardest when retirees are locked into a fixed withdrawal rate. You're taking out the same nominal amount each year, but that amount has less purchasing power, so your real income falls. To maintain your lifestyle, you might need to withdraw more principal, which accelerates portfolio depletion. Meanwhile, your safe bond cushion does nothing to shield you. Its income lags consumer prices, and its principal value can collapse if rates rise in response to inflation, creating a one-two punch of capital losses and shrinking real income. In a true inflationary crisis, think energy shocks, supply chain breakdowns, or aggressive monetary expansion, this effect compounds, turning a balanced plan into a fragile one. Retirees can be caught off guard because traditional models assume modest, predictable inflation and stable yields, not the volatile spikes we've seen in recent years. Recognizing that a classic 60-40 mix offers no defense against simultaneous inflation and market downturns is crucial. Without alternative hedges, like Treasury inflation-protected securities, real assets, or dynamic withdrawal strategies, your retirement plan can collapse under the weight of inflation's relentless erosion, leaving you with diminishing purchasing power and an income shortfall you never saw coming. When markets seize up, even the most liquid assets can become locked up just when you need cash most, turning your safe portfolio into an illiquid trap. In a true crisis, bond markets can go dark. Trading desks retreat. Bid-ask spreads widen dramatically, and large investors bulk trades into auctions rather than open markets. That means you may find yourself unable to sell your treasuries or corporate debt at anything close to face value. Worse yet, if you've borrowed on margin or against your portfolio, something many retirees avoid but some use to smooth withdrawals, you can face margin calls at precisely the worst moment, forcing you to liquidate assets at fire sale prices. Even sophisticated liquid alternatives like certain ETFs can suspend redemptions during volatility spikes, leaving you stranded. For retirees who planned on tapping their bond cushion to weather a downturn, these liquidity crunches are a brutal reminder that safe doesn't always mean accessible. And on the equity side, trading halts or circuit breakers can delay your ability to free up cash, while high-frequency traders and institutional algos dominate the order flow, pushing smaller retail trades to the back of the queue with punishing price slippage. Imagine needing to cover an unexpected medical bill or simply fund your monthly spending, only to discover that selling even a portion of your liquid portfolio would lock in massive losses or might not be possible until days later, by which time markets could be even further down. Forced sales in such conditions can decimate your savings, turning sequence of returns risk into sequence of liquidity risk. This is why a truly crash-resilient plan must account not just for asset allocation, but for guaranteed sources of cash, laddered CDs, pre-funded cash reserves, or credit facilities tested in both calm and crisis scenarios. Without these contingencies, your safe mix can collapse under the weight of its own illiquidity, leaving you cash poor, stressed, and scrambling in exactly the moment you can least afford it. There is a better path than watching your safe portfolio crumble. Build a crash-resilient plan that doesn't rely on a single 60-40 mix, but instead weaves together multiple defenses. Start with a dynamic allocation framework that automatically shifts weight away from vulnerable assets when risk indicators flash red. Think lowering equity exposure and dialing back long-duration bonds as volatility or interest rate signals spike, then ramping back in once stability returns. Pair this with tail risk hedges such as low-cost options or inverse ETFs calibrated to deliver outsized gains in extreme downturns. These instruments may feel like insurance premiums in calm markets, but they can pay off enormously when both stocks and bonds sell off together. Next, incorporate Treasury inflation-protected securities, TIPS, or real asset allocations, commodities, real estate investment trusts, even carefully selected infrastructure funds that tend to hold value or appreciate when inflation and uncertainty rise. These holdings don't just protect against purchasing power erosion, they also act as ballast when traditional bonds falter. Layer in a multi-bucket income strategy, a short-term cash reserve funded by laddered CDs or high-yield savings for your next 3 years of expenses, plus a midterm bucket of short-term bond ladders or dividend-focused ETFs for moderate growth in income, and a long-term bucket of diversified equities and real assets for compounding returns. When your cash bucket nears depletion, refill it from the midterm ladder if markets are stable or from tail risk hedges if a crash is underway. Finally, test your plan in stress scenario simulations, historical market collapses, stagflation periods, sudden rate shocks, and ensure you have prearranged liquidity sources such as a low-cost line of credit that you can tap without disrupting your core portfolio. By combining automated risk management, strategic hedges, inflation buffers, and a disciplined bucket system, you transform a brittle, safe plan into a nimble, crash-resilient framework. One designed not just to survive the next market epoch,